Measurement fundamentals. In this example, we're going to look at when should revenue be recognized. Here we have 4 questions to answer, and basically a company makes toasters and sells them to a store. And there's a recent order for 500 toasters at a price of $100 per unit, and the costs are $40 a unit. Notice that the number of toasters that are produced total to 500, but the production is spread over 3 years. 200 the first year, 200 the second, and 100 the third. Whereas the delivery schedule is a little different. We delivered 150 toasters the first year, 200 the second, and 150 the third. So we fulfilled the shipment of this order of 500 toasters. Now in Part A it says, assume that we recognize revenue when the toasters are produced. If that was the case in year 1, since we produced 200 toasters and the sales price is $100 a toaster, that means that we would have, that would be $20,000. In year 2, if we produce 200 toasters at $100 each, that would be $20,000 again for revenue for the second year. In the third year, since it's 100 toasters times $100, that would be $10,000. Versus in Part B, if we recognize revenue at delivery, how much should be recognized in each of the 3 years? In year 1, we only delivered 150 toasters at $100 or $15,000. In year 2, if we deliver 200 toasters at $100, that would be $20,000. And in year 3, if I deliver 150 toasters at $100, that would be $15,000 again. In total, notice the revenue is the same, $50,000. It's just that the timing of the revenue recognition changes. In Part C, it says calculate the net income for the 3 periods under each of the 2 assumptions above. So looking at that, if it's based on production, notice here's our revenue, here's our expenses at $40 each. So our net income, when it's produced, is $12,000, $12,000, and $6,000, or $30,000 net income in total. Whereas if we instead recognize or make our income statement based upon when the title passes and the goods are shipped, notice the total net income is still $30,000, but the net income each year is different. It's only $9,000 in the first year, $12,000 in the second, and $9,000 in the third. So in total, the income statements are the same, but the revenue recognized each year and its associated or matched costs change. So question D, if the management is paid on an income-based bonus, which of the 2 assumptions would they prefer? Well, I think I would prefer production, and the reason is I front load my net income. Thus, my bonus will be greater in those early years. So, this is a good example of why it is so important as to when should you recognize revenue. And remember, there are the 2 criteria about when it is earned and when the cash is realized or realizable are what should govern when that revenue is recognized, not when it's produced.